As we move into a new year, it may be tempting to think, well, I'm going to buy the dogs of last year. Our guest says it might be best to stick with the winners of 2025. We're joined by Tony Ciero, President and Chief Investment Officer at Caldwell Asset Management. Tony, great to see you. Thanks very much indeed for joining us. So you stick with the winners. You say, for example, that Canadian banks and U.S. stocks still look good this year.
Yes, they do. Happy New Year, Andrew. Pleasure seeing you again. Absolutely. And why the Canadian banks? We look across the board last year, they went up about 30% or so, led by the Royal Bank. TD actually had a nice rebound. So if you bought the loser 2024, in 2025, you did quite well. But the reasons are, you got to start with the interest rates. Interest rates are coming down in Canada. There's been a hold the last time the Bank of Canada met, but the expectation is interest rates will continue to cut. And that's just going to improve the bank's loan loss provisions. Some of the issues the bank suffered a couple of years ago was when rates were higher, they're putting more money aside to potential bad loans down the road. And that takes away from the bottom line. Now, also with interest rates coming down, you start seeing a steepening of the yield curve, meaning your short-term rates are lower than your long-term rates. And that bodes very well for banks' net interest margin ratios, which is a key metric when we look at earnings on a quarterly basis. And why the net interest margin ratio increases? Well, banks, they lend you money long-term. When you take out a mortgage, it's 30 plus years. And when you invest with them, well, GIC, that you invest 1 to 5 years. So that spread on the yield curve that increases, the bank will make a premium on that. And finally, the wealth management division across all major banks here in Canada did quite well last year. And just think of it, that's the asset management division. And if investment assets went up 10, 20% because of market growth last year, well, you're just earning that much more of a spread in terms of fees for this year. So definitely Canadian banks continue playing that. U.S. equities, well, the economy is still conducive to growth. Low interest rates, tax cuts, and business spending conducive to growth. And you look at AI infrastructure spend, it continues to be prominent. And that eventually will add more to the overall economy. So yes, Canadian banks, U.S. equities, and I'll mention one more, gold. Gold did quite well last year, 60%, but there's no signs of any slowdown there. As the U.S. dollar continues to be weakened, a lot of pressure to weaken the U.S. dollar. And as you mentioned earlier, there's a lot ongoing geopolitical risk continuing out there. Investors do tend to flock to gold when that happens. So gold prices can continue to soar going forward.
What about the big AI names? What's your feeling there, Tony?
Yeah, there's two that we like and we continue to like, and they were sort of the laggards last year. So if you do want to buy something that's down in price or didn't perform as well, Amazon is our top pick. And when you look at Amazon, you have to look at the AWS, their cloud computing platform. I actually had somebody ask me the other day, what is cloud computing anyways? Major businesses, before computers, everything was paper-based and you file it away in a cabinet. Then they went to computers and you open up these double doors down the wing of the branch and these massive servers are behind these double doors with blinking lights and wire connections. So those are the servers that the data was stored for major corporations or many corporations. Now, cloud computing takes away from those servers. You don't need these servers anymore because you offload it to the cloud computing platform. And more businesses are going that route. And that's just going to bode well for cloud computing platforms like AWS and even Microsoft's Azure cloud computing program. Amazon as well, last year it did not do so well because of the threat of tariffs. They still have that e-commerce platform, the online retail shopping, that was affected drastically last year because of the threat of tariffs. The goods that you're buying are going to be increased in price because of the tariffs applied to it. But now that rhetoric has sort of been displaced. And let's see if that e-commerce platform picks up revenues again as more and more of us feel more comfortable going back and buying online.
Broadly speaking, do you think investors will look askance at Canada this year because of Trump's threats to our sovereignty? And of course, we're vulnerable on the trade front. We have a very open economy here.
Yeah, many views on there, and some wild views could be that, yeah, Venezuela is just a prelude that can continue out in the Caribbean. Then you look at Denmark with Greenland, and then potentially Canada because of our resources. I don't want to go necessarily down that rabbit hole. In the grand scheme of thing, with what Trump did in Venezuela, he ousted a dictator that was bad for the country. And that's why I think the markets have done well. Plus, there's some oil that freed up because of that. So the markets like that a lot. But let's hope it doesn't go down the rabbit hole like a lot of us are concerned about eventually taking over Greenland and then Canada.
Tony, thank you very much indeed. Tony Ciero, President and Chief Investment Officer at Caldwell Asset Management.